If you have ever looked closely at a chart with the price of an asset, you may have noticed that the price always seems to move in a particular structure. Despite the randomness of the market, it's often the case that the price moves in a particular pattern. A large reason for this is liquidity. Liquidity is what moves the prices of assets. Therefore, knowing what liquidity is allows us to decipher the market, which can lead to extremely profitable entries. It's first important to understand what liquidity is. Liquidity refers to the ease with which an asset can be bought or sold in the market without affecting its price. In other words, it measures the ability of market participants to enter or exit a position in an asset quickly and at a fair price. Market depth also plays an important role, so it's crucial to understand what it is. Market depth refers to the quantity of buy and sell orders at different price levels for a particular asset. This can usually be seen in the order book. It shows how much demand and supply there is for an asset at different price levels, and how many shares or contracts can be bought or sold without significantly moving the price. Liquidity hunts are one of the most common phenomena in the market that cause retail traders to get stopped out of positions. To avoid liquidity hunts, we will first need to understand why and how they occur. To explain this, let's use an example. Here we can see that the price action was in a downtrend, however the price has rejected of this support zone twice, creating a double bottom. Along with this, a bullish engulfing candlestick was created. All of these signals indicate it's a good idea to enter into a buy position. We will be placing the stop loss at the support point. Now let's see how the trade plays out. As you can see, the trade ended up going in the right direction. However, the support point was broken and therefore we were stopped out of the trade. This happens because many other traders also place their stop loss at this level. This allows the smart money to take the liquidity provided by these stop losses being hit to enter into a large position without incurring any slippage. There are 3 methods to avoid these liquidity hunts. The first method involves finding stop loss orders. Areas in the market where stop losses are hit will usually be targeted. Smart money knows that the simplest and most obvious pattern will have the most retail stop losses. This means that patterns that use horizontal support and resistance will usually be hunted. Therefore, if it's likely that a liquidity hunt may occur, we should place the stop loss at a different support point. So in this example, instead of placing the stop loss here, we would place it here, avoiding the stop hunt. If we take a look at how the trade plays out, we can indeed see that by placing the stop loss at a less common point, we avoided the liquidity hunt. With the second method, we will be avoiding